Bill Ackman raised $5 billion. By the end of day one, $900 million of it was gone. But here's what almost nobody is asking. If Ackman's track record is real, and it is, why did institutions walk away from this deal? Why did a $25 billion vision become a $5 billion raise? And why did the investors who got in at $50 lose 18% by the time the closing bell rang? Here's the reality. The story everyone told about this IPO wasn't wrong. It was incomplete, and the part that was missing, that's what we're covering today. Hey, welcome to New Stock Signals. I'm Max, the digital twin of Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. Bill personally researches and writes every video script himself. I hope you enjoy. He reads every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. Let's get into it. Here's the reality. What happened to Pershing Square USA in its April debut wasn't just one bad IPO day. It was a new stock signal. And if you know how to read it, it tells you something important about where capital's flowing, who gets hurt, and why structure matters more than a brand name. By the end of this video, you'll know exactly what happened, why it happened, and what it means for your approach to IPO investing. Let me give you the facts first. Bill Ackman's Pershing Square Capital launched two separate entities. There was PSUS, the closed-end fund, priced at $50, closed at $40.90s. That's an 18% drop on day one. Then there was PS, the asset management company, listed separately, also fell. 2 years ago, Ackman floated the idea of raising $25 billion for this vehicle. He ended up coming to market at $5 billion to $10 billion. Then he raised $5 billion, the low end. By the close of trading, paper losses approached $900 million. That's the starting point. Now let me tell you what it means. Ackman isn't shy about his ambition. He wants to build a Berkshire Hathaway for the next generation. Permanent capital, long-term compounding. Annual meetings where investors ask questions directly. That's actually a serious idea. Warren Buffett's genius wasn't just stock picking. It was building a vehicle where he never had to sell under pressure. No redemptions, no quarterly panics, just compounding. Ackman has studied that model. He believes it deeply. Here's the key insight. Pershing Square's track record is real. Since 2004, 2,600% cumulative net returns, according to Pershing Square's marketing materials. The S&P 500 returned 836% over the same period. One of his most famous trades, in early 2020, Ackman built a credit protection position that cost around $27 million in premiums. Within weeks, as COVID roiled markets, that position returned $2.6 billion. That's not luck. That's pattern recognition under pressure. So why did PSUS fall 18% on day one? This is the part that matters. Most investors looked at Ackman's track record and bought the story. But the structure told a different version. PSUS is a closed-end fund. That's not the same as a mutual fund or an ETF. Closed-end funds often trade at a discount to NAV, the actual value of the underlying assets. That's not a quirk. It's the norm. The moment PSUS went public, there was real risk it would trade below the value of what it holds. And it did. Here's what most retail investors didn't see coming. The deal was cut dramatically, multiple times. Each cut was a signal. Institutional investors, the ones with the sharpest pencils, were walking away from this deal at higher prices. When institutions pull back, retail investors are left holding the gap. That's not new. That's IPO history repeating itself. Let me ask you something. When you see a famous name on an IPO, does that make you more interested or more cautious? Drop your answer in the comments. I read everyone. Because the answer to that question determines a lot about your long-term results. I want to be fair here. Ackman did something different. He structured PSUS with no performance fees, meaning he doesn't take a cut of gains above a certain threshold the way most hedge funds do. He said the retail investor usually gets cut back, that institutions are favored, and that he did the opposite. That's the right instinct. The portfolio itself, Amazon, Uber, Brookfield, these are legitimate large cap positions. But here's what the market said when PSUS began trading. The instinct was right, but the pricing was wrong. The IPO was priced for perfection. At $50 per share, there was no margin of safety, no cushion for uncertainty, no discount built in for the structure. The market corrected that in a single trading session. That's not a scandal. That's price discovery doing its job. Here's the real lesson. Brand doesn't replace structure. Track record doesn't replace pricing discipline. Every time a high-profile manager comes to market, whether it's Ackman today or someone else tomorrow, the fundamental questions are the same. What am I actually buying? What does the structure cost me? And what's already priced in? Ackman's long-term track record may still be excellent. PSUS may eventually trade above its IPO price. But investors who paid $50 on day one, they took on that risk without getting compensated for it. Here's what I'd watch now. 1. Does PSUS stabilize and find a floor, or does the discount widen further? 2. What do institutional holders do in the first 30 to 90 days? That tells you whether the smart money is staying or leaving. 3. Does the annual meeting format, Berkshire style, actually build a loyal shareholder base over time? The vehicle could still work. The idea is sound. The lesson isn't that Ackman failed. The lesson is that structure and pricing discipline matter every single time. Investors don't lose money because they pick the wrong manager. They lose money because they ignore the mechanics. If this is the kind of analysis you want more of, subscribe. We cover IPOs, new stocks, and the AI market reset every week. The kind of institutional grade insight that used to be reserved for the big players. Now it's available to every serious investor. Hit like, subscribe, and drop a comment. I want to know what will be your single biggest question about the next big closed-end fund IPO. Structure beats story every time.